Want to talk about the risks of inaction, holding and hoping with deep in the money naked put positions, deep out of the money covered calls, credit spreads or debit spreads that have moved against you. Now, we all know the way the market's been that many neutral to bullish positions are underwater. Covered calls, naked puts, bullish spread positions, calendar call, bullish spread positions, long calls, even long calls that are bought out to January 2023 might be seeing a 70 or 80% loss. I had 3 coaching sessions this week and about 4 to 5 emails and a couple of general phone calls about positions where investors sort of didn't pay enough attention, or they were holding and hoping that something that had gone down so far may have a potential to come back, but now they're looking at a position that's at a 70, 80, 90% loss on the trade. That discussion we had last week for Stuart on the risks of selling or rolling a covered call to a strike price below the cost basis was sort of a similar position here, a similar discussion that we're about to have. But it covered sort of the topic of letting something get away from you and then still hoping you can manage it when the losses got too high. Just like holding a stock position. If we were just stockholders and, the stock had dropped 20, 30, 40, 50% and we took no action at any time, now how do we prepare that? Do we just average down, throw more money into a bad position? We can try the stock repair as options traders. We know that if it's available. But there's a line that you don't want to cross. And unfortunately, at times, you don't want to just hope the market's going to come back. End of April, we had a discussion too. You can find that on YouTube. That'll go a little bit more in depth. This, I believe it's also on the Power Options webinar screens, but rolling a deep in the money naked put, and perhaps the hope that a deep in the money naked put will not be assigned, even if it's out till January. The reason I mentioned that is that was Sal's question, where he had some deep in the money naked put positions for January 2023 expiration. And he was commenting on why would he be assigned if it's that deep in the money, even early? Why would he be assigned, period? What is this thing he heard from his broker about a trade just being cleared out and not being assigned even if it's in the money? Well, I had a coaching session this week. Customer had COUP. The position was entered a while ago as a repair from a previous position, but the customer had sold 6 contracts of the January 23 200 or 210 puts. He got exercised this week on 2 of the 6 contracts. Now he owns 200 shares of COUP at 210, which is trading at about $72, $73 per share. And he has 4 remaining contracts still open that he does not want to be assigned on. And they are out to January 2023. So they were still assigned early, exercised early in that case, and he now owns the shares of stock. Thankfully, when this adjustment was done, it was far enough out in time to receive $106 or so in premium, and the buyback cost was $149 at the time. I actually believe when I was having this discussion with him, the stock was closer to 75 or 80, if I remember correctly. In any case, I think it was near 70. My apologies. So during the coaching session, we discussed ideas on managing and repairing the stock, using the stock repair if available, selling some out of the money but below the cost basis price of the position. This cost basis was 104, so it's really not that bad, but it's still bad if you count the premium that was received. And then we talked about managing and adjusting the 4 remaining contracts. Now, I bring this up because there were multiple questions like this that came in. Naked puts that were deep in the money, some coming up to expiration soon, some 4 or 5 months out in time. Also deep out of the money covered calls where a position was bought at 80, the 85 call was sold, and now the stock was down to $52 or $53. And I saw this post earlier this week. This is showing some known stocks and some recently famous stocks and their price drop from the highs in 2021. I looked most of these up, and most of the highs were somewhere around, of course, where the market was high. We were looking at December and November of 2021, right before the start of 2022 and everything that we've experienced in the last 5 months or so. Now, some of these have come back slightly, and a couple have gotten worse. And this was with an article this was in an article that was posted about the meme and the Reddit stocks that had given back all of their pandemic profits. And we think about some of the names here: Robinhood, HOOD. This had a bad, terrible earnings and it dropped down, but I think it's back up to about 1050 or so, 1060 today. Rivian pulled back about another, came back up, I should say, about another 15, 20% today, I believe. Coin came back slightly, but it was down drastically after their earnings. Peloton is almost dead in the water. And these two here are interesting. I want to point these out, both Upstart Lending and SoFi Lending. They're both down extremes as well. Palantir took a big hit for earnings. We see Etsy down from 73% of its high. Snap, Square, Zillow down 70%, Facebook at 50. Shopify is a big one at 82. That's a big name. Teladoc 83. They got hit with earnings. And of course, NVIDIA at 50% as well. Now, why I'm saying this is that some of these stocks we expect to recover. Some of the bigger name stocks, and of course, this is just speculation. This is just my opinion. I don't have anything to back it up. But I'd expect to see NVIDIA come back up. Is it going to go back up, that increase to get back to its high? No, I'm talking an increase of maybe 10, 15, maybe 20% over the next few months. Facebook, we expect to recover possibly as well, but we know there's problems there. There's money problems with the advertising, and that's why one of the reasons the stock's taken a hit, plus tech being routed. But some of these pandemic darlings, I don't know if they're ever going to come back to near highs. I don't think Robinhood's ever going to come back to where it was. I don't think we're going to see Peloton come back anywhere either. Coin, I just don't know because it tracks Bitcoin, but big nervous fear there. I don't know how many of you saw their earnings when they released it, but with their earnings report, when they mentioned in the call, I believe, or in an interview after their earnings call, the CEO made mention that if in fact Coinbase does go bankrupt, investors holding Bitcoin amounts in the Coinbase wallets are likely to lose all of their funds because they'd be dissolved into the bankruptcy itself. That's something no investor wants to hear and no one using their product wants to hear. That's a very, very dangerous warning sign and something that you're going to want to pay attention to. But in any case, yeah, depending on what they do, Netflix might come back, but look at all of the competition that's out there now for streaming services. They're getting beat down because tech's being routed, because the pandemic stocks are disappearing, because the Fed's pulling money out of the market that inflated it. We all know that. But also, there's too much competition now. How they move forward is going to reflect their management and if they can come back to a reasonable level. The reason a moment ago I circled SoFi and Upstart is I don't know how many of you were trading in the market back during 2007, 2008, and 2009. After the bottom, and things started to come back up, some companies never recovered. Some companies went bankrupt. Others got bought out, and there was this mass of mergers of who was left. Well, think about it this way. You've got two lending companies here down significant amounts from their highs in the last several months, SoFi and Upstart. They're in sort of the same competitive business. How do you get better for your investors in the stock? How do you increase company performance? You need clients that the other company has. It wouldn't surprise me to start seeing massive mergers, buyouts, and things of that nature by the company that was able to survive the best because they have to increase the money that they're holding, the amount that they're lending, the customers that they're using, and the payments that are coming in. Sometimes the best way to do that is to take over. Zillow's one I'm not sure may ever recover. Definitely not back to where it was. You've got a lot of competition there now. You've got Redfin, you've got Realtor.com, you've got a couple of these other ones that are out there as well. But Zillow is a strong company. It's been out there for a long time. It's been in the business for a long time. It made a lot of advancements. It could be the result that Zillow starts buying out some of these other ones if they have enough money, if they were responsible, and so forth. So don't take this as any investing advice. I'm just kind of showing some of these things where we stand and some of the things that got away. But in action to these types of positions, just like holding a long stock position that keeps dropping and dropping and dropping, holding and hoping on an options play can hurt worse. You should never let a covered call or a naked put get beyond a 10% loss, or the stock falls 10% while you're in the position. You're going to need to roll it at that time, add some protection, hedge the bet, or just get out of it and find a position that matches your sentiment. Don't just hold, and hope something's going to come back. Yes, it's been a stressful market. Things have gotten away from people. Things have gotten away from us. I know that. Roll, adjust, or hedge before the losses get too big. Most importantly, as always, have a trading plan, an exit strategy, triggers for alerts to stop the bleeding too much, and apply that plan. Also, very important, practice proper position sizing. Don't get into any position, of course, that can cause too much of a margin requirement or too much of a loss that you're not willing to take. Now, the idea of the trading plan and the exit strategy brings me to another topic that came in via email. This was from a customer that came in, and the customer said, I used the search tool under Naked Put and decided to sell some monthlies of the Naked Puts on Interactive Brokers and paper just to understand. Which is good. Goal with Naked Puts is to get some income and not be assigned. Out of the money, cash secured Naked Puts, relatively high probability of expiring worthless. Now, in the paper trading, some of them are still out of the money, while some are in the money. And then they commented that buying to close the in the money ones leads to a loss. So I thought a good strategy would be to roll them using future expiry dates to lower the price and keep going. And this could give some proceeds, if I'm not mistaken. Yes, rolling down and out, a popular approach. But in a kind of steep market decline that we've seen, that can actually get you into trouble too. If it keeps going down and going down, sometimes you might want to buy it back and just take the loss and look for a stock that is performing, or an inverse that is performing in the negative market. And the strategy could be to roll them endlessly. Is this something you advise a good strategy or not? Now, I'm going to go through my initial response. My initial email response was, when a naked or cash secured put goes in the money, investor may do one of three things. May take assignment, convert it to the covered call to try to make back any losses. Roll down and out, as the customer suggested in his email. Close the position for the loss. Look to make that up with naked puts on other stocks that are matching the sentiment for the trade. Go on to say rolling down can be effective management, but you have to have a bullish expectation that the stock will recover. It's not always the best idea to keep rolling down, and rolling down a naked put or a covered call on the stock that's falling. On the covered call, you're losing more on the stock than you're gaining with the option premium. Can you keep rolling? Yes. Is it a good idea to keep rolling? Not necessarily. Sometimes it's better to cut, take the loss on that position, go apply the strategy to another underlying security that matches the sentiment for that strategy at this time, rather than feel locked into attempting, I have to repair this stock ABC. I have to keep trading Peloton. I have to keep trading down coin and rolling down naked puts and rolling down covered calls, or even ARK-K, for example, as an ETF. Sometimes you just want and need to close that position, take the loss if it's not too big, try not to focus on making back on that particular underlying, make it back in the market on other stocks that are now matching the sentiment for the trade. Most important, develop a strategy and trading plan. Look to close or roll the naked put if the stock drops 7 to 10% from your initial entry. Close or roll the naked put if the stock reaches within 1% of the short put strike price before it goes in the money. You've heard me say this before in various webinars on managing naked puts and rollouts. Close the position, of course, if the technicals or fundamentals of the underlying change and you're no longer neutral to bullish on the stock. And of course, you can take a look at various management webinars on YouTube in the playlist section there. Repairing a naked cash secured put, of course, and there's other ones. An important one is when to stop managing a naked put position. But then the customer had a follow-up. The customer said, I watched when to stop managing a naked put video, and I have a question. I tried the 1% out of the money rule and decided to buy to close the position, but many times the premium was higher than the income coming in. Of course. So I'm wondering if it could be better to set, say, a 2% out of the money trigger or something like that to get some proceeds. The 1% rule is more designed to keep us out of trouble, to pick a price to reevaluate the sentiment on the position, take action by closing or rolling down the position before the cash secured or naked put goes in the money. Due to the effect of the at-the-money bell curve, the sold option will be relatively just as expensive if it's 2% out of the money in a few days as it is if it's only 1% out of the money in a few days. If the stock is falling, the put options will increase even as time passes due to this ATM bell curve. The ATM bell curve shows us that the option that is trading at the money will always have the highest time value of all the options on the chain. We can actually see a swelling of extrinsic value in those cases when our once out of the money put was right at the money or within 1 or 2%. That is going to swell up to this curve as the stock falls, and our new options here are at the money where we may have initially sold for that lower premium and higher probability. Also, in this type of jumpy, in this type of bearish market, but in this type of sudden jump down, sudden hope to climb back up, but then sudden drops back down, you're probably closing positions more often at the 2% rule and not hitting the win targets you're expecting with your trading plan. That's the risk of setting too high of a stop. Say, well, if I opened a position where I was 7% out of the money, why wouldn't I set a stop at 3.5% halfway? Because you're probably closing positions 45 to 50% of the time, and you're not going to be able to hit your targets closing positions that often. Let's take a look at a quick example. This is AIG. This isn't a naked put position. This is a position I'm in as a married put that's done very well for me during these past 4 months, was able to generate income, lower the risk down to 1.5%, and still have the put out to August for protection. But on May 5th, when AIG was at 62.12, we could have sold to open the 20th of May 57.5 put for 58 cents. It's 7.4% out of the money with a stock at 62.12. That's a 1% naked yield for 15 days out in time. So 58 cents against a maximum risk of 56.92. The 1% stop would be set at 58.08. The 2% stop would be set at 58.65. Seems like we're splitting hairs here, but let's take a look. Going forward, remember we received a 58-cent premium. May 6th, AIG was at 62.23, moved up 12 cents in one day. The 20th of May, standard expiration 57.5 put dropped to 45 cents. We've got a 13-cent profit. We're still 7.6% out of the money. May 9th, AIG falls to 59.61. Our put is at 98 cents. We took in the 58-cent premium, so we're at a 40-cent loss if we close it now, but hey, we're still 3.5% out of the money. On May 10th, AIG is at 58.69. The 20th of May, 57.50 put is at 113. This is a 55-cent loss, almost double the initial premium that we received in, and it's 2% out of the money. The 2% rule was effectively triggered. If we didn't trigger it, well, 2% rule is at 58.65, so if it's at 58.69 here, we didn't close it, but on May 11th, AIG is at 58.61. The 20th of May, 57.5 puts at 110. We have a 52-cent loss on the position, 1.9% out of the money. May 12th, almost the same story. The put goes back up to 113, 55-cent loss. It's 1.5% out of the money. And today at the close, AIG is at 58.55. May 57.5 put is at 80 cents. So it's a 22-cent loss on the position. Another day of time value decayed in our favor. Volatility came down a little bit. And in any case, 1.8% out of the money. We didn't hit the 1% rule in this case. The option was still open. We didn't take a loss. And the maximum loss was a loss, as we mentioned, of 55 cents here. But it probably would have been closed here, let's say, in that case, at 52 cents. And, so near 1-to-1 loss ratio of what we expected to make it back with one trade later on as well. But the 1% rule wasn't hit. Now, is it going to be better with a shorter term trade? Same position, but let's say we took the weekly May 13th expiring today rather than the standard May 20th. So on May 5th, AIG is at 62.12. Same strike, 13th of May, 57.5 puts at 33 cents. A little bit better annualized return than 2 weeks out at 58 cents. Still 7.5% out of the money. We're getting a 0.6% naked yield for 8 days. So it's a similar trade, but what happens going forward? May 6th again, 62.23. That 57.5 put drops to 20 cents. We've got a 13% profit. Excuse me, we're still 7.6% out of the money. May 9th, AIG at 59.61. The put goes up to 53 cents. We're at a 20-cent loss, and we're 3.5% out of the money. May 10th, 2.1% out of the money. Maybe the 2% rule wasn't triggered, but the put's at 60 cents. So we'd have a 27-cent loss. Again, almost a 1-to-1 to what we were expecting to make, a little bit lower though. May 11th, AIG at 58.61. We're at 45 cents. I'm sorry about that, folks. We're at a 12-cent loss. It copied over wrong. We're at a 12-cent loss in this case. Yesterday, May 12th, it's at 35 cents. We're at a 2-cent loss, 1.5% out of the money. And then on May 13th, we get the full profit. But again, this likely would have been closed. Now, I'll admit, on a shorter term weekly trade that was only 7-8 days out in time, I might actually use more of only a 0.5% stop instead of a 1%, because it's shorter time and especially in a volatile market that we're in. But what I was trying just to illustrate here for the customers is that there's nothing wrong with either stop. But this is an exercise to illustrate the effect of the ATM bell curve and extrinsic swell. The cost to buy back, or to buy back to complete a roll as it's moving down, is going to be higher at the 2% stop unless it happens on the very last day. The ATM bell curve, it's going to cost more to buy it back, whether it's at 2% out of the money from where you started or 1% out of the money. That's what's going to happen. The 1% rule is based on testing for both bull puts and naked puts. Where we ran these tests over time, the 1% stop resulted in a higher success rate because we weren't closing positions as often, and in the end, higher returns than using a 2 or 3% stop. But the key is to have a plan that matches your risk tolerance, and most importantly, stick to it. What is your comfort level? Again, there's nothing wrong with either stop. We use the 1% rule based on what we've seen in testing and what has worked for us. If you're more comfortable with the 2%, that's perfectly fine, but you want to test it. You want to see how many times would you have been closed out more frequently with the 2% stop, taking into account that with the ATM bell curve, that buyback cost is likely to be higher than when you initially sold it, especially on a 1-week or a 2-week trade, just due to the ATM bell curve effect. Now, I do want to make a quick disclaimer here. This was to illustrate the effect of the ATM bell curve and how when the stock's dropping, the put is going to swell in price. Even if you started 5% out of the money or 7% out of the money, and now you're 3% out of the money, we saw that the buyback cost was higher. Even if it just fell 3%, the buyback cost is higher because it's going further and further on that ATM bell curve. Unless it happens on the very last day, you're likely to pay more as the stock is declining, even though it's still out of the money because of that extrinsic factor of the ATM bell curve. I use closing prices to illustrate this between the 1% and 2% stop, but in real trading reality, both stops were hit during intraday trading on May 10th. The 2% stop would have also been hit on May 11th, May 12th, and of course, as we saw on May 13th. The 1% stop was hit on May 10th as well, and on May 12th. The monetary losses were similar for both stops, whether you were looking at the 13th of May expiration, the 20th of May expiration during intraday trading. But I didn't want to get into each tick and each price, but they were about the same. And you can see here how using just the 1% rule versus the 2% rule, it's still going to cost you more to buy it back to close it because of the ATM bell curve. Again, most importantly, find a stop that's you, that fits your comfort zone. Have the plan, stick to it. And of course, from what we talked about a few minutes ago, don't overthink your trading plan. Stick to your stops. Don't let something go against you. A cash secured naked put, a covered call, a long call, even if it's 4 or 5 months out in time. Don't let it get to a 15, 20, 30, 40, 50% loss on the stock as it's just going down in terrible market conditions. Stick to your plan, control your losses. As my mother always says, keep your powder dry, which again is one of the reasons why I advocate for the married put and the radioactive trading techniques, standard collar protected positions in uncertain markets to control that risk, keep most of your investments intact, guaranteed better than a stop order.